Hello everyone and welcome to another edition of ChartYourTrade.com's free webinar series. I am your host, Michael Lamont. I am the founder of ChartYourTrade.com, and today we're going to learn how to identify market health in 3 steps. Part 1. With us again is keynote speaker Adam Sarhan. Adam is the founder and CEO of Sarhan Capital, which is parent to FindLeadingStocks.com. Without further ado, here's Adam.
Welcome to tonight's presentation. DAMP is an overview of a investment system that I put together, which basically helps create the structure and the framework needed to help me do well in the market. It's an acronym which is broken down to 4 main points. D stands for defense first, and the idea there is really to respect risk. You want to win by not losing. You want to define how much money you're going to lose if you're wrong. It gives you structure with respect to your portfolio, what happens when you're wrong, and how much of your portfolio you lose if you're wrong. This way, you actually have a good bearing at all times where your portfolio is and how much you have at risk, whether or not some adverse market event occurs, which would adversely affect your portfolio. So really, when you have a good grasp of how much you're going to risk before you enter a trade, it really helps you create an overall formula to say, okay, I'm comfortable taking this amount of risk. So you don't have too much what I call portfolio heat, or you're not staying up late at night, can't lose sleep because you have too much risk in the market. The A stands for advanced buy and sell signals, and we have several other presentations about that, but more or less the idea there is to get in before the crowd, not to enter correctly, and you want to get out at opportune moments as well. And it's all about probabilities. You want to enter when the probability of success are in your favor and exit when the trend is turning. Market conditions stands for do not fight the tape and follow market trends. Those are 2 main points which we'll be discussing tonight in depth. Actually, this whole section tonight is going to be focused on market conditions. P stands for psychological analysis. Now, this is a really an interesting point of view. Lots of people study markets. They look at fundamental analysis. They look at technical analysis, but they do not focus on psychological analysis. And from my point of view, that is the most important criteria, because after you learn the basics of trading or the basics of investing, the real nuances and the skilled investors, the successful investors that are able to go up there and traders do year after year after year after year, decade after decade of consistent returns, do it by creating and maintaining a healthy psychological state. And a lot of this business is all about how you think and really the emotions. If you're able to separate your emotions from the decision-making process, you'll do very, very well, irrespective of what your underlying investment style is, whether you're a fundamental guy, a value guy, a technical guy, straightly a quant guy, whatever the case may be. But the psychology of the market, and more importantly of yourself, is extremely, extremely important for you to have a grasp on. So without further ado, let's take a look at the M in DAMP, which is market conditions. There are 7 sections we're going to be talking about tonight. Number 1, we follow market trends. It's very important to align yourself with what is actually happening, not what you think will happen. One of our sayings around the office is we trade on what we see happening, not what we think will happen. And that's really, really important. Number 2, understand the concept of most stocks follow the market, why that's important. And then number 3 is multiple time frames. There's lots of different time frames in the market. You can look at daily, weekly, monthly, intra-week, quarterly, annual. The idea here is to help you understand what the overall health is of the market and what your sweet spot is with respect to your trading. Do you want to be an intraday scalper? Do you want to be an intermediate term trader, a longer term investor? And then find out what the underlying health of the market is in that desired time frame that you choose. And the beauty here is you're free to choose any time frame you want. The technical and fundamental tools that we use to help ascertain the health of the market will be discussed. Number 5 is do not fight the tape. 6 is your stocks versus the market. We'll talk about some interesting things there with respect to relative strength and how to tell whether or not you own the right stocks, and some subtle but very important buy signals and sell signals to look for based on how your stocks are acting compared to the overall market. And then you want to take a look at market tops and bottoms, and then we'll take a look and really address this issue, because there's a lot of confusion with respect to how markets actually top and how they bottom. For the first component here is you want to follow market trends. So just to help keep things very, very simple, there's only 3 things a market can do at any given time. It either can go up, it can go down, or it can go sideways. I call them 3 states of the market. Now, within these uptrends, you can have sideways moves, and you can also have small down moves within an uptrend. Within sideways action, more or less, you can have short-term uptrends, and if it bounces between support and resistance, or you have a downward trend where it goes from resistance to support. But they're very small in the time frame, it might happen on a daily chart, but a weekly or monthly, it's moving sideways. That's a good way to help talk about which state the market is in, depending on the time frame you look at. And then the downtrend, you have also can switch back and forth to the up and sideways. And the idea there is just to understand what the overall market trend is. Are you trending up? Right now, we're in a very strong bull market. The bull market began 5 years ago in March of '09, and now we're in July, about to be July of 2014. So we're about a little over 5 years into this bull market. There's no question we're in a strong uptrend. We haven't had a 10% pullback in the S&P since 2012 in about 2 years. So the trend is clearly up. Now, during that time, you can have sideways moves, and since the last 5 years, you've had two steep corrections. One was 17% when QE1 ended, and then one was 21% when QE2 ended. So those were two downtrends within the broader uptrend. But for the most part, when you're looking for the follow the market trends, ask yourself is on a longer term chart, the longer you go, the better, what is the market doing? Is it moving from the lower left to the upper right, or the upper left to the lower right? And if you can stand at the other side of the room and just look at the screen, that'll help you answer the question. Or it might be moving sideways where you don't have a definitive trend. So it's really important to align yourself with how the market is trending at all times. If you're in an uptrend, you want to be long or neutral. By long, we just mean to own stocks. That the position being long is that you buy a stock and you make money when the stock goes up or the market goes up. Now, or an ETF, whatever the case may be. When you're short, it's the exact opposite. You short a stock, you make money when the stock or the ETF goes down. So either you're long or you're neutral. By neutral means you're in cash and you have no positions in uptrends. In downtrends, you want to be short or neutral. And when the market's moving sideways, like it did for the first 4.5, 5 months of this year, really you want to be flat or in the same direction as the broader trend. So what happened was in 2013, the S&P was up 29%, and then the first 4 or 5 months of 14, it took a break. It needed to digest that very, very strong move from 2013, and that's very healthy. So that was a long sideways period for about 5 months where the S&P didn't do anything. It just moved sideways, but within a longer uptrend. At the end of May, early June, the uptrend resumed, and now the S&P, based on this recording, is at new all-time highs yet again. So really you want to ask yourself from a positioning standpoint, am I positioned with the trend? Am I following the overall market trend? And if not, there must be a very good reason why not, because more or less the idea here is to stack the odds in your favor. And by allowing yourself to ask yourself what is happening with the market first and foremost, and then whether or not am I following it or not, it does two things. It takes your ego out of the equation. And number two, it forces you to be aligned with what is actually happening in the market at all times. Another important notion is that most stocks follow the market. Now, typically, the vast majority of stocks, if not all leading stocks, follow the market. And that's well with ETFs. So if you have strong areas of the market, you really want to see those are the ETFs, and within them, what the strongest stocks are in those groups and in those sectors, and then ask yourself, what is the market? I mean, if you're in an uptrend, and are my stocks leading the market? That's really the goal. And when you're able to look at your portfolio and say, you know what, I don't really have stocks that are leading the market. The stocks that I own are not doing as well. Well, at that case, you know there's a disconnect. And then you can ask yourself, what do I need to do to change it? And the good news is you're free to change it at any given time. You're not stuck, and you don't have to be in, and you don't have to be long, you don't have to be short. There's a lot of flexibility here. So let's talk about leading stocks just for a second. There's lots of ways to define leading stocks. And the way that I define leadership is based on performance. How is the stock performing year to date in the last 12 months, whatever the case may be, based on itself, other stocks? There's over about 10,000 stocks out there. So out of the liquid stocks that I look at, I don't like to deal with penny stocks. I don't deal with penny stocks, period. I don't deal with thinly traded stocks. I want a minimum of 500,000 shares or more. I tend to look at small cap at the very, very low end of 3 to 500 million market cap or higher, preferably higher. And the idea there is to ask yourself, how are these stocks, out of all the stocks in the universe that you look at, whether small caps, mid caps, all caps, whatever the case may be, how are the stocks that you're looking at, or the stocks that you're looking at, how are they performing relative to their peers? And then how are they performing relative to the market, whether it's the S&P or the NASDAQ, whatever you pick, the Dow, it doesn't really matter. But the most common one is the S&P to use as a benchmark. So those are two components. So the way that I find leadership, by definition, is just looking for the creme de la creme as far as as the overall stock performance is concerned, and then also how the stock is performing compared to the market. And the stronger it is, the better. And conversely, the weaker it's performing, if it's underperforming the market, the worse off it is. So by definition, I won't have a leading stock, even if it has superb fundamentals, but the stock's hitting a 52-week low, I wouldn't consider that a leading stock, especially if the market's at a 52-week high. So really keep in mind there that there's a lot more towards the definition of leadership, and how you define it for you is what matters. I'm just telling you what works for me. So for me, it's a sheer price performance definition, and as long as it meets my criteria, in other words, it's not an illiquid stock, it's not a penny stock, all that fun stuff. It's a highly traded stock, it's liquid, it's institutional quality, it's got enough liquidity in there for people to move in and out comfortably. In other words, it trades at least 500,000 shares, but preferably 1 million shares or more a day on average. Then you know that you're looking at the right universe of stocks. Now, here's a little subtle hint or buy signal, sell signal, little trick of the trade that I've picked up over the years. If you look at your portfolio, let's say you have 7 or 8 stocks or 10 stocks, or whatever the case may be, or even more, it depends on your preference. But you have a stock that is not participating in the rally. Right now, the S&P is at new all-time highs. You're in a clear uptrend. The market's rallying. There's no questions. Your stock is just sitting there. You bought it well, supposedly, based on your rules, and the stock's not moving. To me, that's a yellow flag, where you got the red flag, or you can use the traffic lights. You got green, yellow, and red. So you got a situation here where you're not quite at red where you stop yourself out of it, but it's yellow and it's definitely moving into that red camp. Whereas if you have a stock that broke out while the market's moving sideways, like for the Find Leading Stock service, what we did was we began buying in April, and then in May we did most of our buying before the S&P broke out to new highs. And that was because the earlier you see stocks break out, the better, period. And that's a buy signal. So if the market's moving sideways and you see a stock break out, that's very healthy, especially if it's within a broader uptrend in the market. That's exactly what we're seeing now. Now, if you see a market moving down and then a stock breaks out or starts moving higher, that begins to say, okay, the broader trend of the market may be shifting, because the healthier the stocks act, by definition, the healthier the major averages will act through time. Another important point, Van Tharp is one of those market wizard psychology guys, and he says people don't trade markets, they trade their beliefs of the market. And that's a really good line that I like, and it's really apropos because it means, whatever each person believes is true, that's what they look for. So it's really important from a buy signal and sell signal, ask yourself, what matters here? And do I own those leaders? Because that's, by definition, what you want. And the way you tell a leading stock is if a stock can go from 10 to 100, it's going to hit new highs time and time again, and that's a great way of finding it. So then you just look for weakness and uptrends, and that's another tactic that we use, that we discuss in the A and DAMP for the advanced entry signals. But suffice it to say, leading stocks act well and they outperform the market. Now, with respect to time frames, again, there's the 3 states of the market. There's up, sideways, or down, period. That's all a market can do, or a stock for that matter. And once you know that, you can filter out all the noise, whether it's latest negative headline du jour, whether it's Iraq, Ukraine, Afghanistan, Argentina defaulting, Greece defaulting, whatever the case may be. Negative headlines come and go all the time. But no matter what happens, the only 3 things a market can do is go up, down, or sideways, period. So you can prepare for those type of events. What happens if the market goes up, the stock goes up, sideways, or it goes down? So the idea is to find a time frame that you're comfortable with. For full disclosure, my preferable time frame is the weekly time frame. With Find Leading Stocks, it's a weekly note. We have intra-week updates, but the big decisions are made on the weekends when the markets are closed. Why? Because for us, our goal is to capture the bulk of the move. We're not trying to pick tops. We're not trying to pick bottoms. We're trying to capture the bulk of the move, and we can do that very effectively by not looking at the intraday or the daily, or waiting for the monthly or the quarterly or the annual, but looking at the weekly. It just happens to be a good sweet spot for us. And also, it adds us another element that helps us a lot with the psychology part of DAMP, the P. It allows us to make rational decisions when the markets are closed. We can find leading stock and say, you know what, this stock's pulling back, so we're going to buy that leader on weakness. If this stock goes above X point, in other words, just most recently we bought Tesla at 214 and change, you can identify a leading stock and say, okay, there's only 3 things this stock is going to do. If it goes higher and you have an advanced entry point or even your classic buy point, whatever the case may be, you can prepare for that over the weekend when the market's closed. And then we have a subsequent stop, always advertised to all the members in advance before the week even opens, before the market opens for the week, and then the whole idea is just to trade the plan. And this way, there's no second guessing. There's no, the Fed came out this week, that you have Afghanistan, you got Iraq. In the middle, if I've noticed, if I don't have that structure in place ahead of time, I second guess myself all day long, and I end up either freezing or just making emotional decisions. So by having a plan in place ahead of time, that's what we do with fine leading stocks, allows you to make rational decisions, not emotional, and that puts you way ahead of the game. So that's really the idea. If you're a good intraday, or you want to be a scalper or a swing trader, whatever the case, whatever time frame works for you, find out what the state of the market is, the trend is in that exact time frame, and then look above or below it. If you're a daily guy, look at the weekly, look at the intraday week. If you're a monthly guy, look at the weekly. If you're a quarterly guy, look at how the monthly is going or the annual. So just go up and down a few time frames and just make sure you're in sync with the overall trend. And if you're in that uptrend, or that the up state, that okay, it's good to be long. If you're in the downtrend, you more or less you want to be short or neutral, and sideways you got to ask yourself, is the uptrend ending and we're topping out, or is the downtrend ending and we're bottoming out? So really, those are the keys that need to be discussed with respect to time frames. Just like a stock, support and resistance come into play, and it's very, very important to understand the concept. To me, trading is an art; it's not a science. So the idea here is this black line, these arrows, more or less, every time this stock pulls back to this area, 51 and a quarter, it bounces. Now, it's not to the penny, but it's a zone. Here it briefly undercuts, here it briefly undercuts, and what happens? It bounces right back up. And that's very, very healthy because more or less, you see buyers step up and defend that area. And resistance is the exact opposite. So every time the stock or the market gets up to this area, in this case it's 50-50, it's a different example, it falls. Bounces again, falls. And then a breakout inevitably is when it breaks above resistance, and a breakdown is when it breaks below support. The point of bringing up these two slides is just for you to understand the concept that the market works the same way with stocks, because this is all psychology. It's just crowd behavior being illustrated in real time. So some technical tools that we use to help identify the trend of the market is we look for that up the states. Is it up, is it down, or is it sideways, the broader trend? And then is the trend changing? As we've mentioned before, which we'll get to again later, are you transitioning from a topping process? You were in an uptrend for years, and now is it moving sideways, and you break down below support, that more or less, after some time passes, could be a possible top. The opposite is true with downtrends, where you have a downtrend for a year, 2 years, 3 years, whatever the case may be, a vicious bear market. All of a sudden, you move sideways for a few weeks or months or years, and then all of a sudden, blast off, and you have a nice uptrend begins, like what happened in March of 2009 or October of 2002, where you start seeing these big tectonic changes in the trend, from downtrends ending and then uptrends beginning. And then major tops have happened just recently. You had October 2007 and you had March of 2000, where you had just major tops develop. And then the market broke support and the trend changed. So always ask yourself, are we in that up, down, or sideways phase, or is it the trend changing? And if so, be prepared and adjust accordingly. Another way of asking yourself as a technical tool is, what % of stocks and the market itself is above or below an important high? So here's a good way of saying it. If you have a market that just hit a new 52-week high, or your stock, and then all of a sudden the market pulls back 3% or 4%, is that good or bad? It pulls back 8%, is that good or bad? A really, really important thing to do with markets and trading in general, investing, is keep things simple. People have a natural tendency to overcomplicate and thus overthink and confuse themselves when they don't understand these topics. And trading, investing, there's a lot of moving parts, there's a lot of noise, there's an infinite number of ways to make money trading, literally an infinite. There's so many different ways of doing it. It's just a matter of finding one that works for you. And your brain, there's almost 10,000 stocks out there that are traded. You can't process all that information. So invariably what happens is the vast majority of information that just crosses your screen every day, or you hear on the media, or whatever the case may be, is just noise, and it confuses you. If you can keep it simple by saying there's up, down, or sideways, period, then you're able to make intelligent decisions. But if you overcomplicate things and look at all the tick, they call it tickositis, where you stare at every tick, invariably you're going to make mistakes, you're going to confuse yourself, you're going to second guess yourself, and then you're just off the track. So really part of that process is studying the facts. So we've gone back, I've studied all these different bull and bear markets going back to late 1800s. I've studied economics cycles, both bull and bear, boom and bust rather, going back to the 3rd century, and all that's available on fineleadingstocks.com. Basically, it's normal and it's healthy to see the market pull back. And also, forget about the labels. You see people in the paper like to say, oh, you're in a correction, you need to count the number of days, and all this convoluted nonsense. It's too much. Keep it simple. The way markets work, just like at the end of the day, you need to go to bed, you need to sleep, you need to rest. At the end of a move, now, I don't mean end, in other words, the move's over, but after a move, rather, that's a better way of saying it, the market has to pull back. It consolidates the move. Now, when you understand at the end of the day you need to sleep, then you understand markets need to pull back. Now, that shifts your whole focus. Instead of being fearful when a pullback occurs, you're now optimistic and you're expecting it, so you can anticipate the pullback. And as long as that pullback is shallow in what I call size, a small percent decline, typically under 10%, and scope, it's short, meaning it's not a number of days or number of weeks, even a short number of months, doesn't drag on and on and on, that's a healthy pullback. Just like if you don't sleep, some sleep deprivation tactics, if you don't sleep at all, it's potentially fatal. Same thing with the market. Uptrends, even downtrends. You need to see that market consolidate. And there's only two ways markets can consolidate. Either move sideways for a brief period of time and then moves higher, or it moves lower. And then it sets itself up again to resume the prevailing trend. So in uptrends, you see a nice 4, 5, 6% pullback. It pauses and then blasts off again. And we saw that happen this year. You had almost a 30% rally in 2013. The first 5 months of 2014, the stock market moved sideways. At the deepest, the S&P was down about 6%. It's a shallow pullback. At the time, I can't tell you how many people came out and said, oh, we're topping out, the market's going to crash, ... yada, yada, yada. All the negativity came out of the woodworks. Meanwhile, a few weeks later, if not a month and change, you're at new all-time highs again. So anticipate those pullbacks. Don't be fearful of them. And then always differentiate between a minor healthy pullback and something more severe.
Thank you all for watching, and we hope that you enjoyed this video. If you were watching us on YouTube, please take a moment and click the like button here at the bottom, and also take a moment to subscribe to us here on YouTube. If you'd like to try out Adam Sarhan's Find Leading Stocks service and see all of these concepts in action, visit findleadingstocks.com and save 10% off of any membership level when you sign up. Simply go to findleadingstocks.com, enter discount code CYT, and claim your 10% discount. Thanks again for watching, and have a great day.